$45 billion. Wired by the Saudi Public Investment Fund to a Japanese telecommunications holding company in 2017. No independent due diligence, no exit clause, no board vote from a body with teeth. Just the number, and a handshake wrapped in sovereign ambition. Most people who heard the story filed it under visionary. That is the first mistake. Masayoshi Son had a thesis. He called it the Singularity, a moment when artificial intelligence would fundamentally restructure every major industry on Earth, and the companies positioned ahead of that moment would capture value on a scale the world had never seen. He framed SoftBank as the instrument of that thesis. Patient capital, long horizon conviction, a fund so large it could shape the trajectory of technology itself rather than merely bet on it. The Vision Fund would be $100 billion. It would move fast. It would move first. And it would move with the blessing of the most ambitious sovereign wealth apparatus on the planet. The press believed it. The limited partners believed it. Crown Prince Mohammed bin Salman, who had pledged to modernize Saudi Arabia's economy and diversify it away from oil dependency, saw the Vision Fund as a vehicle. Access to Silicon Valley's deal flow, geopolitical credibility, and a visible symbol of Saudi Arabia as a serious global capital allocator. Mubadala, Abu Dhabi's sovereign fund, committed $15 billion. PF committed $45. Together, they provided $60 billion, 60% of the entire fund, to a structure they did not control, in assets they could not exit. That structure is where the story actually lives. SoftBank served as general partner. In private equity, that title is not ceremonial. It means you control deployment decisions, you control timing, you control information, and you collect carried interest, typically 20% of profits above a hurdle rate, in addition to a management fee on committed capital. On $100 billion, the math on fees alone is a number that would make most people reconsider their relationship with ambition. SoftBank collected it regardless of performance. That is not a footnote. That is the engine. The sovereign LP received preferred equity in the fund structure, a 7% annual coupon on their committed capital before SoftBank participated in any upside. On paper, that sounds like protection. In practice, it was a ceiling on the upside and an illusion of a floor on the downside. Preferred equity does not protect you from principal loss when the underlying assets deteriorate. It simply means you get paid before the equity holders, which is only meaningful if there is something left to pay you with. When portfolio NAV collapses, the coupon is a rounding error. Now look at what SoftBank actually contributed. Approximately $28 billion by the fund's own reporting. But a significant portion of that contribution was not fresh cash. It was equity stakes SoftBank already held. Positions in Alibaba, in ARM Holdings, transferred into the fund at marked-up valuations. This is the mechanism that transforms a telecom company into an asset management operation. You take your existing paper, your already appreciated positions, place them into a new vehicle at current marks, bring in $60 billion of external capital alongside them, charge that capital a fee for the privilege of your deal flow, retain the carried interest on all gains, and structurally separate your balance sheet from the downside. The sovereign LPs were not investing alongside SoftBank. They were providing liquidity that SoftBank could deploy, at SoftBank's discretion, into SoftBank's relationships, under SoftBank's control. While their own capital sat in illiquid private positions, they had no mechanism to exit. Illiquidity is not incidental to this structure. It is foundational. When you hold preferred equity in a closed-end private fund with no secondary market, no redemption window, and no exit clause, your leverage over the GP is exactly zero. You cannot vote with your feet. You cannot pressure through withdrawal. You are structurally captured. And the GP knows it from the moment the wire clears. The portfolio itself is what most people remember: WeWork, which SoftBank valued at $47 billion before its implosion and subsequent collapse of its IPO in 2019. Katerra, a construction technology company that burned through $2 billion in capital before filing for bankruptcy in 2021. Greensill Capital, whose default triggered cascading losses across multiple investment structures. These were not minor line items. They were flagship bets, held at marks that reflected the GP's conviction more than any observable market signal. The LPs had no independent ability to challenge those marks. Information asymmetry between GP and LP is not a flaw in the model. It is the model. The GP always knows more about the underlying assets than the LP. The question is whether that asymmetry is maintained deliberately. In Vision Fund 1, the answer is structural. The losses, when they arrived, were categorical. SoftBank reported a Vision Fund loss of approximately $27.4 billion for fiscal year 2022, the largest single-year corporate loss in Japanese history. Cumulative Vision Fund 1 write-ins exceeded $50 billion by 2023. But track who absorbed those losses at the margin. The sovereign LP held positions they could not liquidate in companies whose valuations had been set by the same entity managing their capital. Their 7% coupon became a liability in any scenario where fund NAV dropped below the preferred hurdle. Mubadala and PIF faced write-downs on assets they had no path to exit, controlled by an entity whose interests were not aligned with their recovery. Masayoshi Son's personal fortune declined. He acknowledged mistakes publicly. But the institutional infrastructure of SoftBank remained intact. The management company survived. The carry agreement survived. And Vision Fund 2 was launched, this time with SoftBank's own capital, without the sovereign LP structure, which, read correctly, tells you everything about what the first structure was designed to accomplish. The broader pattern here is worth naming without sentiment. Sovereign wealth funds operate with an objective function that is not purely financial. PIF, in 2017, was not simply seeking risk-adjusted returns. It was seeking access to deal flow, to Silicon Valley relationships, to the credibility that comes from being embedded in the ecosystem of global technology capital. That objective is real, and it has value. But it creates a systematic vulnerability. When access and prestige are part of the objective function, you will accept structurally inferior terms to secure them. You will accept a preferred equity wrapper that sounds protective and isn't. You will accept illiquidity you cannot manage. You will accept information asymmetry you cannot close. Because the alternative, not being in the room, feels worse than the terms inside it. SoftBank did not deceive anyone with documents that said something other than what they meant. The term sheet said what it said. The structure was disclosed. The carry was disclosed. The illiquidity was disclosed. What was not disclosed, because it cannot be disclosed in a term sheet, is how those terms compound against you when the portfolio deteriorates and the GP retains full control of the timeline. That is not fraud. That is architecture. The Saudis received a seat at the table, a press release, and a front-row view of how $100 billion disappears into private market marks that no one outside the GP can independently verify. Masayoshi Son received carried interest, management fees, fees, and a second fund. The structure worked exactly as designed for the party that designed it.